Good morning, everyone. Today is October 1st. I love October. Why? Because it's my birthday month and because I love Halloween. And they're only 2 days apart. So, today, big story. We have the manufacturing, and construction numbers come out. That's going to be important because that's going to tell us whether the U.S. is spending money on construction or whether they're being more cautious on construction. If US is being cautious on construction, that's going to impact the GDP because GDP takes into account overall quarterly growth and construction spending is a big part of that. So it's going to be a very important report, and especially the ISM Manufacturers Index that's coming out at 10 a.m. Keep your eye out on that. Now, global markets, U.S. and China trade dispute, hurting global economy. The sides will hold talks next few days, but a slew of uncertainties, including the impeachment inquiry into U.S. President Trump, left businesses reluctant to spend due to uncertainty over trade war. More importantly, Prime Minister Boris Johnson said his government was preparing to make formal proposal for a new deal with EU. So there's a lot of global tension. Whether this impeachment is going to have any legs to it, I don't think so, but who knows? Boris Johnson with Brexit, there's a lot of uncertainty there. As a matter of fact, if you look at the long bond right now, it's a little cooler this morning. It's down by about 1.30%. Not significant, but the bonds are cooler. Stocks are a little firmer. We're up about 0.2%, 2.26% overnight, but we're still hovering near the 50-day line. I don't like that. And the fact that volatility is declining near the 50-day line is not a positive sign. When you take that into account with the fact that the Russell 2000, the 2000 mid cap, small, it's called Russell 2000 small caps, but it's really mid caps to smaller caps. Notice it's right at the 50-day moving average. It's actually penetrating the 50-day moving average to the downside. That's not positive. And that's going to pull the overall stock market lower, or at least cause it to congest. Therefore, don't expect a lot of upside from the S&P 500. Now, looking at the NASDAQ, looking at techs, notice we're also below the 50-day line. That's not positive. Let's see here. Let me put on the 200-day. So we're still a while from the 200-day, but the fact that the top 100 stocks out of the S&P 500 are trading below the 50-day moving average, at least the tech stocks, that's not positive. That's not positive at all, and that's going to give everyone a big pause. Keep in mind, you have 500 of the largest cap stocks in the S&P 500, but the smaller 2,000 stocks are pushing it down. The top 100 tech stocks in the S&P 500, the NASDAQ 100, they're all in the S&P 500. They're pushing it lower. Don't expect too much from the S&P 500. Keep your eye out on the manufacturing index. That's going to impact Thursdays and Fridays job numbers. That's going to put a distortion filter on it, so to speak, because if the numbers are low, it may impact. Because construction spending, a lot of it has to do with employment. If construction spending is weak, it's going to impact, it's going to bite into employment. So again, keep those numbers in mind. The expectations are, let me just give you something to expect. Consensus is between 49.1 and 52. So we're looking at 50. Anything around 50, we should be okay. But again, this is not going to bring back the tech. That's blue chips. Let's look at the Dow while we're here. I want to see if the Dow is above or below the 50-day line. The Dow should be higher because it doesn't have any tech in it, but let's take a look. Yeah. So blue chips are holding this market higher right now, not technology. Remember a few days ago, technology and utilities were competing for number one spot, and I said that's really wrong. When you have the most speculative sector and the most defensive sector neck to neck, that's not right. Usually when utilities lead, speculative like tech or consumer discretionary is in last place, and they're neck to neck. Now finally tech is moving lower, but here's the problem. If these reports here today are weak, that's going to push the Dow Jones and the New York Stock Exchange down to the 50-day line. And then what's going to hold the S&P 500 higher? Because we already know that it's not going to be the Russell 2000, right? And we know it's not going to be the technology stocks because, well, they're below the 50-day moving average, as you can see here. So the only thing that's holding up the S&P 500 right now is blue chips, bank stocks, construction stocks, consumer staples. And if they're going to start drifting, keep your eye on that Dow, because if the Dow starts drifting, that's the diamond, that's the Dow right here. That's the ETF equivalent of the Dow. If you see the Dow start drifting to the 50-day line, bye-bye S&P 500. So construction numbers, keep your eye on the construction numbers today. Keep your eye on blue chips. Keep your eye on blue chips. And it's time to get defensive and neutral on speculative stocks, at least till the NASDAQ is above the 50-day line 2 days in a row. Hope that helps. Don't go overboard right now with your portfolio. This is a good time to be defensive. Lower your exposure. Volatility is going to pick up right now. When volatility picks up, it increases your exposure. Let me give you a quick example. Let's say you have 100 shares of a stock and it's moving $1. That's $100 that your account is moving every day. Let's say that same stock now moves $2 a day. Now your account is moving $200 a day. You still have 100 shares, but they went from $100 to $200. So keep your eye on your portfolio and lower your exposure. Lower your exposure if the Dow hits the 50-day line. The 50-day line is at 26,500, 26,600. Keep your eye out on that. And if you're looking at the Dow ETF, it's at 265.95-ish. Talk to you soon.